seminar that is being promoted by the International Finance Corporation, IFC. It's a member of the World Bank Group, and we are the main international institution focused on development and working with the private sector in emerging markets. I am Carlos Serrano. I'm responsible for business development for the Climate Finance Financial Institutions Group in Latin America and the Caribbean. And I am also leading the IFC Green Banking Academy, which is our initiative to support the transformational journey from banking as usual to sustainable responsible banking of banks in the region. By providing advisory services, of course, green financing, and something very, very important, which is training and capacity building. This is our 10th webinar from the series Ctrl+Alt+Delete Green Rebuild that we launched by the end of May with the idea of keeping a message. And the message is that we need to bid for a sustainable reconstruction once that we pass through this emergency and through the crisis generated by the pandemic. And the future has to be sustainable, and the banking sector plays a fundamental role on it. We named this series Ctrl+Alt+Delete Green Rebuild because control, it's really give us the opportunity to influence and to control in a way the future that we want to give us to ourselves. It's called because we believe that there are other alternatives to rebuild a better world, and we have the option to select between those ones that are going to have a positive influence and those ones that not. And it's delete from the mistakes from the past and try to avoid them in the immediate future. This COVID crisis has been an important notice that major crisis and with more irreversible impact can be ahead of us if we don't take action. And climate change and the climate impact, it's one that obviously it's in front of us. We have the responsibility to learn from the mistakes, and we can develop together with the banking sector and with all the investors community a new approach. So that's why we are proposing a green rebuild, a sustainable rebuild in which we work hard with ambition, with inclusion, with passion to rectify the way to transform and to rebuild a better world for everyone. We're bidding for a sustainable economic reconstruction where we increase the resilience and the sustainability of our economic systems. So we are promoting investment in sustainable infrastructure, in renewable generation, in innovation and technologies, clean technologies. This webinar is going to be our 10th webinar, and we have distinguished panelists with us, and the topic is sustainable capital markets, which are fundamental to this agenda that I have just shared with you. Right now, the climate finance global flows are in a level of around 600 billion per year. And in order to keep the temperature increase below the 1.5 degrees that are needed to avoid serious damage, we need huge amounts. We need between 1.6 and 3.4 trillion US dollars. So as you can see, the gap is enormous. And that's why it's so relevant. And we brought in this webinar the sustainable capital market option that are at a crossroad. There are a lot of money from responsible investors that needs to be channeled to close that gap, that climate financing gap. And in this panel, in this webinar today, we are going to tackle this. Let me share now a little bit of the logistics. We are going to have a one hour long webinar, and we have a moderator with us, Peter Cashon, that I will introduce right now. And it will be followed by opening remarks from our two distinguished panelists today. After that, we will have a turn for questions and answers, and I kindly suggest you to post your questions in the section that we have in the WebEx. Please write your questions, and we will read it to the panelists. And with further ado, I'm going to introduce our moderator today, who is my colleague Peter Cushion. Peter is Chief Investment Officer, and since June 15, 2020, he's the head of climate finance in the Financial Institution Group, FIG, at IFC. Peter leads the climate finance business, which makes more than 1.5 billion in annual investments in the financial sector in emerging markets. And also he leads advisory services, climate advisory services program that develop the capacity of financial system and institutions to deliver on climate finance targets. Just to share with you that we have a very ambitious target at IFC. It's 35% right now, and even with a larger aspirational target of all the money that we lend has to be for sustainable purposes. So this just represents the level of commitment and the level of ambition that we have, which is aligned with the huge opportunity that we see in the market and the need. And I'm going to give the floor to Peter Cushion. Peter, please, the floor is yours.
Great, thank you very much, Carlos, and thank you everyone for joining. It's a real pleasure to be here with you today. Let me first start by sharing the objectives from today's webinar. Our topic today is the green rebuild, unlocking sustainable capital markets in the post-COVID-19 economy. As we know, capital markets are a critical component to meet the financing needs for climate investment in the green rebuild. But why is this? The reason is we estimate that there's over 20 trillion in climate investment needed in emerging markets over the next decade. This is a huge number. And although banks and FIs are a key component of delivering on climate finance, they're unable to meet this need. So there's a major funding gap. And really the only way to fill this gap is through capital markets. And they must make a critical contribution to filling this gap. One of the challenges that we see, though, is that capital markets in many developing countries do not have the depth to meet these funding needs. And to date, it's really been a game more in the millions rather than the billions. In the billions and eventually the trillions are really what we need. But the good news is that there's been incredible growth in the green bond market. It grew over 60% in the past year. And I believe that IFC's played an important role in moving climate capital markets into the billions. Both through our own bond issuance program, through IFC's bond issuance from our treasury, and through innovative deals such as the IFC Amundi Ego Green Bond Fund. So with that background, I'd now like to turn it over to our panelists who will discuss the important contribution of capital markets in a sustainable economic recovery as part of the COVID-19 crisis response. So first, it's my honor and pleasure to introduce Julie Becker. Julie is the Deputy CEO and leads the international primary markets at the Luxembourg Stock Exchange. She has responsibility for the management of the listing activities and the development of the Lux SE market for a range of securities. She's a confirmed specialist in regulatory, legal, and market-related matters linked to capital markets transactions. In 2016, Julie Becker initiated and implemented the creation of the Luxembourg Green Exchange, or LGX, and this is a new platform that was dedicated exclusively to green instruments. This initiative, which is the first in global capital markets, has been rewarded with numerous rewards and recognition. And she's been appointed in 2016 to the EU High-Level Expert Group on Sustainable Finance. So truly an expert in her field covering capital markets and climate. So Julie, we'd like to turn it over to you for some opening remarks. Thank you. Julie, you may be on mute.
Thank you, Peter. So can you hear me now? Great.
Yes, perfectly.
Good morning, good afternoon all. When IFC reached out to ask if I would participate in today's webinar, it was my honor to accept. I need to give a sense of purpose to what I'm doing. Sustainable finance is about making a positive impact through financial investments. It's about creating a better and fairer world for those who need it the most, about contributing to sustainable development and the transition into a more inclusive economy. It's about societal prosperity and how to make it last. If there's one thing that I would like you to take away from today, is a common understanding, no ifs and whens, that we all need to act now, especially as we know what is needed. What we do from this moment onwards will not only define the legacy that we will leave for future generations, but also the finance industry as we know it today. The COVID-19 pandemic has forced us to rethink our mindset, our convictions, our assumptions, and our behaviors. And most importantly, rethink the way that we act towards our society at large. As Carlos mentioned, all of this will require enormous investments. And as the Vice President of the EU Parliament said at the occasion of the launch of the EU Action Plan on Sustainable Finance, without money, you can dream, but with money, you can act. And that's precisely the reason why capital markets play a crucial role in accelerating the transition to a low carbon and more inclusive economy. And as Al Gore said, it's also the single biggest business opportunity since the Industrial Revolution. It has the magnitude of the Industrial Revolution, but the speed of the digital revolution. And as the founder of the world's first and leading platform for sustainable securities, the Luxembourg Green Exchange, I have witnessed this firsthand. We launched LGX in 2016 as a response to the Paris Climate Agreement and the UN Sustainable Development Goals. Our objective for LGX is precisely to unlock sustainable finance and guide capital in the right direction towards sustainable development projects. As of 30th of June 2020, a few days ago, LGX is the home of over 760 sustainable instruments, worth a total of 285 billion euro. But this is only the tip of the iceberg of what is needed today, as Peter just mentioned. The green bond market, as we know it today, started in 2007 when the EIB, the European Investment Bank, listed the world's first CAB, or Climate Awareness Bond, at the Luxembourg Stock Exchange. The World Bank closely followed by issuing the first green bond in 2008. And since then, we have come a long way. IFC itself, as an issuer, directly issued 172 green bonds and 33 social bonds in total. Green bonds made partly way to social and sustainability bonds that focused on not only projects that benefited our environment, but also the people living within. And this in turn led to the creation of SRI and ESG funds. And since then, things have developed fast, but still, we have only merely started. So many of you may be wondering what role you can play in the future of sustainable finance, how you can act and contribute. And it's really my hope that today's webinar will leave no doubt in your mind that whether you are an issuer or an investor, you can and must play a role in shaping the world of the future by mobilizing and guiding funds in the right direction to the right projects. We all have a role to play to make the financial system more inclusive, transparent, and responsible, and thereby ensure sustainable growth with real impact, real-world impact. We need to make sustainable finance accessible and simple to broaden the overall market understanding and acceptance of the foundation of sustainable finance. Many financial institutions and investors would like to contribute to sustainable development, but they lack the necessary market knowledge. The LGX team has frequently been asked to share its knowledge and experience both at regulatory and practical level. And this is the reason why we launched the LGX Academy back in May. One of the missions of an exchange is to ensure investors' protection, and this starts with raising awareness and education, exactly like the Green Banking Academy of IFC, This is what we intend to achieve with the LGX Academy, together with partners like universities, business schools, and institutional partners like IFC through the technical assistance funds of the EGO Fund that will be further detailed by Jean-Marie. Sustainable thinking and investing, along with adequate financial products, must become the standard of capital markets. And for this, transparency is key. Intermediaries such as stock exchanges have a role to play when it comes to facilitating information flow and data disclosure. We need to be able to provide investors with complete, structured, and meaningful data sets that they can understand and that allows them to compare products and investment options. And for issuers to use them for the launch of sustainable investment products that cover investors' needs and will shape our future. Investors deserve the clearest guidance, the best disclosure, the easiest access to relevant data if we are to bridge the investment gap that we see at work within sustainable capital markets today. Again, as an exchange, one of our missions is to protect investors by providing transparency and ensuring all needed information is made available to allow them to take well-informed investment decisions. I'm happy to say you all today that Luxembourg is developing a centralized data hub for sustainable data points for bonds and funds to address this matter. And its launch is just around the corner. During the current period of unprecedented market disruption, corporate and sovereign issuers continue to tap the debt capital markets with significant transactions. Through the first part of 2020, the bond market has proven to issuers and investors alike that its depth and resilience set it apart from other markets in time of uncertainty as it continues to deliver large-scale fundings and stable investment opportunities across the globe. However, the world as we knew it before COVID-19 is a very different world to the one that we find ourselves living in today. And more change is not excluded. One positive point we take from this pandemic is that the COVID-19 highlighted the S of social in ESG. In the middle of a global crisis that has led to unprecedented financing needs, sustainable capital markets and sustainable finance have been brought center stage. Investing responsibly is the only way to meet the climate goals of 2030. As we prepare plans for economic recovery from COVID-19 crisis, both public and private sectors have the necessity and the opportunity to design a green, equitable, and resilient recovery to prepare us for further environmental and social crises ahead. It's not about maintaining existing business approaches. It's about building back better. It's about fostering societal prosperity, promoting inclusion, and helping local developments in emerging countries. In short, creating a better and fairer world for those who need it the most. But there are no good guys or bad guys. We should be inclusive rather than judgmental. At the end, it's a journey, and every step matters. To conclude, we have a crucial time ahead of us, and we should not lose sight of the important goals laid out in the Sustainable Development Goals and the UN and the Paris Climate Agreement. We need to continue to work together to make finance and capital markets part of the solution. The momentum is there. This is our time, our responsibility, and our duty to make finance and capital markets sustainable by default. Thank you very much.
Thank you very much, Julie. That's very impressive what LGX has done to date, and your perspectives on the importance of climate finance are really inspiring. So thank you very much for that intervention. I now have the pleasure of introducing Jean-Marie Mas, my colleague. Mr. Mas, he joined IFC in 1994 and has held a series of leadership positions with a focus on direct investment, risk mitigation in emerging markets across a variety of sectors. He oversees an equity portfolio, is looking after creating shareholder value, exiting investments, and as part of IFC's priorities to mitigate the impact of climate change in emerging markets, he conceptualized and led the IFC award-winning Amundi Planet Emerging Green One, the EGO Fund. And this closed in February 2018 and is viewed as the world's largest green bond fund. It's a $2 billion strategy and supported by a design-for-purpose $15 million advisory services program that Julie referred to stimulate the growth of the green bond market. And this is funded by Switzerland, Sweden, and Luxembourg. So Jean-Marie, I have the pleasure to turn over to you for some comments and remarks.
Okay, thank you. Can you hear me? Yes? Okay, so thank you, Peter, thank you, Julie. So I will limit my intervention to 10 minutes. So, and my idea was to start by showing a slide on what's going on in capital markets with real data, so that we see what's going on. And so maybe, can you put the second slide, the second page? Yes. So what this slide is showing is that on the upper left side, we have now $15 trillion of bonds at negative yield in the market, $15 trillion. At the bottom left, what we see is that the total global bond market is about $112 trillion and about 86 trillion is in developed market. So if we do the ratio, it shows that about 17% equivalent of developed market bonds are yielding negative interest, are at negative yield today. So this is extremely important because we can see that the COVID-19 situation has increased the supply of negative yield. Point one. Point two, it has huge consequences for pension funds in Europe and insurance companies in Europe, because Europe is where you have a lot of concentration negative yield. And we expect that this situation will continue in the foreseeable future. If we look at the situation in 2019, we saw a big increase in the value of stock because interest rates were going down, but the COVID situation, as you know, has impacted the value on equity market. So now from an investor standpoint, the big issue is where can they get yield on investment? If equity market is not providing a lot of return, if debt is having negative yield, how can you manage your asset allocation? I was looking the news today in France, and five group posted 17 billion euro of losses today, and it's due to COVID-19 situation. So from the left side of this slide, you see that there is an issue on the yield side. Also, you could see it on the chart on the bottom right side of this slide. Now, if you look at emerging markets, so you could see it's a growing asset class over the past decade. Now, 2/3 of this amount recorded in the slide are from China, and 1/3 are from emerging market outside of China. If we look at hard currency bond, it's $1 trillion, about 1% of total bond, which are hard currency sovereign bond, and $2 trillion are hard currency corporate bond. It's only 2% of the market. So these are not extremely big market in the relative size of the market. However, if we look at the slide on the right side up, what we can see is that yield to maturity emerging market hard currency bond can yield 4.7% as of last week. We could see that it spiked at 7% during the COVID, but that was just a spike. So now the situation is that from the investor standpoint, they have capital to deploy, they need yield, and from emerging market standpoint, they can provide yield and raise money. from an issuer standpoint, it's yield go down, so they can borrow cheaper now than before. Because over the since January 2017, the average yield is 4.5% and 5.5%. Now it's 4.7. It's lower. Now going forward, that's the second part of my intervention, is why green bonds in emerging markets. If you issue a green bond, it's demonstrated that your bonds are oversubscribed more than if they are plain vanilla bond. And because you have a lot of demand from investors for yield in emerging market, if you issue a green bond, you will attract more market interest for more investors. You can better diversify who will be the bond holder. And that it's very important to have a diversified investor base in your bond, because the more diversified it is, the more ability you have to tap the market by issuing new bonds at any point in time in future, if you need wholesale funding via bonds. So what we believe is that there is a good opportunity now for issuers of bond to issue green bond instead of plain vanilla bond and diversify their investor base. Now, in our research at IFC, we found that about 3% of new bond issuance in developed market and in emerging market are green bonds last year. We also found that we have a country like Sweden, where 21% of bonds issued in Sweden are green bonds. So 3% is average, 21 is extreme Sweden. And what we observe is that the way the world is going green, particularly in emerging markets, because in emerging market, that's where you need to build new cities, new building. You have urbanization taking place. You need more energy in production. And now you can produce energy at very competitive cost using renewable energy. Today, if you build a building, it doesn't make much sense to build a building non-green. Because if it's green, it will hold its value better, it will run faster, you will lower your operating cost because you will consume less energy, you will consume less water. So it makes sense to build green for energy production, building, transport. And going forward, what we expect is that banks will de facto have a portfolio which will become greener and greener. Today, in our research, we found that 59% of hard currency bonds issued in emerging market are issued by banks. In emerging market, it compared with 12-14% in developed market. So today, banks are leading the charge in emerging market in issuing green bonds. And we forecast that in the future, this will continue. And our mission at IFC is to try to bring to the market more and more first-time green bond issuers with a particular focus on banks, because banks who need to issue bond can issue green bond. They should find green asset on their balance sheet that they can then use to deploy the proceeds raised via green bonds. So we are strongly believing that there is an opportunity which is very real, which is going to grow in the future. That would be my last point. Today, we have about $700–800 billion of green bonds outstanding. Last year, we got 250 billion of issuance. So at that rate, within 1 year or 1.5 years, we'll be at above 1 trillion of green bond. And we expect it will continue from 1 to 2 to 3 trillion in the future. So the sooner people enter this market, whether it's stock exchange, service provider, issuers, investors, specialized fund, the more you will learn and the more you will benefit from the growth of this market in the future. So that's what I wanted to, that will conclude what I wanted to explain in 10 minutes.
Great, thank you very much, Jean-Marie. So I'd like to pose a couple of questions to each of our guests. I'll start with Julie. Julie, what are the innovative instruments that you consider are relevant to continue expanding sustainable capital markets?
Well, Peter, I think that this is clearly one of the many positive aspects of sustainable finance. Investors are always looking for new ways to positively contribute to the sustainable finance agenda, and issuers will always strive to meet this appetite. And by the way, 2020 is the year of transition, opening for the transition decade. So one such new instrument that has been tested in the market since the end of 2019 and has just been codified by a new set of principles released in June by ICMA is a sustainability-linked bond. These sustainable debt instruments represent a very innovative approach to creating positive impact through financial instruments. They are very different from the traditional green, social, or sustainability bonds in that they are non-use of proceeds instruments. So the issuer can use funds for any corporate purpose without having to pre-identify any specific eligible project, while nevertheless committing to securing a positive and externally verified impact to its investors. So sustainability-linked bonds are generally defined as forward-looking, performance-based bond instruments and can be structured potentially around any SDG or any theme. So they are very broad in terms of issuers that could use them and kind of extra financial impact they can generate. How does it work concretely? The issuer would define an ambitious and externally verified sustainability performance target around scientifically backed KPIs, and it commits to measure progress against this target on at least a yearly basis until its target date. So if they get traction, these instruments have the potential to increase the variety of sustainability financial products impact-conscious investors can choose from. From an issuer perspective, this could be a good funding tool to finance corporate sustainability improvements without having to commit to pre-identifying specific eligible projects aligned to any taxonomy. From an investor's perspective, these instruments come with a tangible promise of impact or even financial compensation if the target is not met, and they would benefit those investors that value impact more than transparency around proceeds allocation or traceability. They also offer a more holistic view on the issuer's sustainability strategy and future ambitions. So any investor is not like another, and the same investor might just want to be exposed to different structures for diversification purposes. In addition, these instruments would potentially offer more diversity in terms of issuer type and KPIs or impact type. So to conclude, while green bonds have seen a massive growth, as Jean-Marie just explained, over the past years and created momentum for social and sustainability bonds as well, the sustainability debt market still represents only a fraction of total debt issuance globally. And at this rate, it will be very difficult to curb climate change and reach the UN SDGs. So SLB and any other new instruments in the pipeline, like transition bonds that are still not clearly defined, have the potential, however, to reorient new capital flows towards an improved sustainability model.
Thank you very much, Julie. Yes, I believe sustainability-linked bonds are really an important innovation. In emerging markets, we're just beginning to see some interest and knowledge, understanding of this. And I think we'll follow the lead of what's happened in Europe in particular, which has seen the most the sustainability-linked issuances. Now I'll turn over to Jean-Marie with a follow-up question. So Jean-Marie, in your opinion, what is the bottleneck that has to be solved to see the green bond market continue to grow and evolve? And in which regions do you see more appetite from investors?
Okay, so in terms of bottleneck, what we observe on our program, particularly technical assistance, is that there is huge need to increase information dissemination about what are green bonds, how to issue a green bond, how to package it, how to bring it to the market. There is a lack of training material, lack of experts able to provide training, lack of curriculum. And last year, we launched our executive education program. So we did 2 cohorts with the Stockholm School of Economics. We invited 20 financial institutions, which were already issuing plain vanilla bond for the most part, but who never issued a green bond. And the idea was to convert them into first-time green bond issuers. Each cohort had 10 banks, and 10 banks sent 3 to 4 people per bank. So that's how we organize ourselves. And what we have observed is that 4 out of 20 became first-time green bond issuers. So it just shows that this kind of approach, focused training, very pragmatic. The main trainer was ICMA, is paying off. So now with the COVID situation, we were planning to do cohort 3 and 4 in March and June this year. It has been cancelled because no international travel could allow us to proceed. So now we are working on creating a digital executive education training based on the curriculum we teach before in Sweden. So we are trying to increase that, but clearly a focus on banks who need wholesale funding via bonds can be converted into first-time green bond issuer. That's, I think, for me, that's what is one of the bottlenecks. The second bottleneck, I see the green bond market a little bit like we were at the beginning of the automobile in the world, substituting to horses. Okay, so at the beginning you had plenty of different types of cars, and then over time you had a standard model of type of cars which became the norm. So today, when we speak about green bonds, the difference between green bond and non-green is information disclosure by green bond issuers to investors. And there are different models of disclosure. And we believe that at some point it should be more standardized. The standardization will lead to the creation of digital database allowing investors to make comparison across bonds and across issuers on how they want to deploy an investment strategy. And naturally, it should lower transaction costs. Particularly in digital world now, you can do a lot of stuff quite cheaply, if you know what is expected. Now, when we look at opportunities, to answer your second question, well, we have done a mapping of all the banks in the world issuing bonds in hard currency, and we made it public in May last year. So what we have found is that in the emerging market, it's about $650 billion market of hard currency bond issued by banks, and it's about 500 issuers. And half of the amount is in China, half is outside of China. And to give an answer, so we have about 350 billion market outstanding of bond hard currency issued by banks outside of China. Okay, and the green bond issuance by itself, it's about $50 billion. So it's not a big market, but it's where we are now. And we expect that it should just grow as we disseminate information and as issuers are more and more aware of what investors are looking for. One of the things I like about green bonds is that it's not a definition specific for emerging market, it's a global definition. So investors who understand what is a green bond in developed market can apply this knowledge to emerging market, which maybe will become then more attractive to mainstream investors. Let's say by contrast with only impact investors, who may be more inclined to be specialist boutique, specialists in emerging market. So I think movement is there. So that's our view.
Great, thank you very much, Jean-Marie. At this point, I will turn it over to my colleague, Marcela Ponce, as she's been receiving some questions from participants, and she can pose those to our panelist. Marcela, over to you.
Thank you, Peter. And yes, indeed. So thank you so much, Jean-Marie and Julie, for your participation and your great insights about the green bond and sustainable capital markets. So I have some questions from the public. First one, I think it's for both of you. So are the capital markets receptive to greenfield developments, particularly in developing markets? What's your feeling around that?
Okay, so maybe what I would say is we can distinguish in the bond market two types of bonds. You have the publicly placed bond, who typically are $300 million minimum, often $500 million, okay, and which typically are the ones who are picked up by indexes like the SEMBI index, which are presented in my slide on upper right corner. So to be included in this kind of index, the bond needs to be 300 million minimum, 5-year minimum at time of placement. So you have this particular market. And then you have a second type of market, which are privately placed bond. And then they can be like 20 million, 50 million, 100 million, much lower than the publicly placed bond. So when we look at emerging markets, in general, the capital markets are not extremely developed. Okay, and there is a need for a lot of education, in my view, first from investors, so that insurance company, pension fund, mutual fund in emerging market see an interest to buy green. And from there, issuers would see why issue a green bond, because they have a demand from investors. And that could be a local currency, private placement type of market. Okay, the public placement bond market is where we have most publicly available information, is US dollar denominated bond market plus yuan denominated market for China. It's very much cross-border dollar-based market. So now when we speak about greenfield, the question is what is the size of the project? Okay, so if it's a very large solar panel plant, you can maybe issue a bond to raise money. But if not, you have no other alternative than a bank loan to leverage your equity with debt. And that's where we believe that banks are well placed to be first-time green bond issuer in a country, but they can accumulate a portfolio of green lending. I don't know if Julie, you want to build on that from your perspective.
Yeah, I fully agree with you, Jean-Marie. What I can add is more for from a public perspective, at least for public funds, which are listed. I agree with you by saying that education is key, and first we need to raise awareness and interest in green finance. Capital markets are there also as an alternative funding to banking loans, of course. And that's the reason why also stock exchanges work together globally and to promote the sustainable finance agenda. And that's the reason why as well last year, since last year, we are cooperating a lot with other exchanges, especially in emerging countries, and signed some cooperation agreement with other stock exchanges, like in Santiago in Chile last summer. To promote the sustainable finance domestic capital markets and bring it to the international scene through the display of domestic green bonds, also at an international level through the Luxembourg Green Exchange.
Yes.
Thank you, Julie. Just a follow-up question on what you just said, Julie. How do you see the role of the stock exchanges changing within the sustainable finance industry in the future?
Yeah. Well, stock exchanges are platforms that encourage transparency. Transparency is key for investors as it triggers accountability from issuers. And so that's also why stock exchanges issue guidelines for ESG reporting to support ESG disclosures of listed companies. So stock exchanges provide or need to provide relevant data for investors. They contribute to educating the market at large, and therefore they play a crucial role, and they are a crucial actor for the acceleration of the sustainability agenda. Exchanges, as I was just mentioning, also exchange best practices among themselves, because we clearly need everybody and all stock exchanges to promote the sustainable finance agenda. And that's why that's the reason why we signed lots of cooperation agreements. And all of these is headed under the Sustainable Stock Exchanges Initiative, under the guidance of the United Nations, which regroups in the meantime almost 100 of exchanges. So stock exchanges clearly play a key role in the development of sustainable capital markets, promoting always transparency.
Thank you, Julie. And maybe this question goes to Jean-Marie. Jean-Marie, do you consider that the development of green taxonomies is relevant for the appropriate development of the green bond market and sustainable capital markets in general?
Well, I would say if you, for me, the way I come to that issue of taxonomy, I follow ICMA green bond principle. And ICMA has defined the use of proceeds, what could be the theme. So it's renewable energy, energy efficiency, low carbon transport, water use, waste recycling, land use right, by and large. Okay, for me, if it meets this requirement, it ticks the box, it can be refinanced by green bond. When I look at taxonomy, so far, you have a lot of taxonomy developed in EU and in China, but it's relevant for their geography, not always easy in other geographies. And one example is I'm looking at now green buildings in emerging market, and it's very difficult to define what is a green building in different geographies because it's linked to climate. And I would say even in France, a green building in northern France is not green in the south of France. So even in a small country like France at global level, it's not easy to define. Okay, so what I'm finding, you need a taxonomy, you need to know what you are doing to deploy your proceed. But for me, the effort should be more on education of first-time green bond issuers to kickstart this market.
Thank you, Jean-Marie. And indeed, I think that the taxonomy work is important, and we from IFC are already working on that in a number of countries globally. And a follow-up question to what you said, and Julie also mentioned regarding capacity building. Delaware says, I believe that the awareness is a prerequisite in enhancing the green bond and sustainable capital markets. But her question is, how we can build capacity, how to build, how long it takes for capacity to be built and result into increasing sustainable capital investment.
Yeah, okay, maybe on that one, I can explain two things, okay? So the first thing is that we can work by creating demonstration effect. So for example, we built the Amundi Planet Emerging Green One Fund. So we raised $1.42 billion at closing in February 2018, but it's a closed-end fund 12-year. So over time, the asset grow by accumulation of yield, which is kept in the fund. So that's why we say it's a $2 billion strategy. So the money came from 15 pension fund insurance companies, fund of fund, mainly in Europe. So via this experience, they can first deploy capital in emerging markets, see what yield they get relative to developed market, and learn via information disclosure, for example, via impact reporting from the fund to investors. So the third thing, we can create demonstration effect like such a vehicle. The fund is listed on the Luxembourg Stock Exchange. And what we are seeing now is that we have secondary market transaction. So that's good because you have new investors who come and buy from existing. It promotes more the asset class. So demonstration effect. The second thing is in the COVID world, now we are digitalizing our information dissemination. And via the e-training program, we have the capacity, that's our target, to do about 10 cohorts of 10 banks per cohort. We can train 100 banks. And what I feel is that maybe doing a digital training can be cheaper and more efficient than classroom training. And we have not much choice under COVID and travel restriction. So the idea is to create this e-training, which come with training material and experts to guide participants. And we also have created some case studies to explain to an issuer how to prepare for green bond issuance and how to issue a green bond, how to inform investors about the green bond. And we accumulate a lot of experience doing that we can then write case studies and disseminate. So that's what the kind of thing we are working on now.
Maybe any thoughts from your side on this very quickly?
Well, about taxonomies and capacity building, I think as Jean-Marie just mentioned, it's very important that we manage to make sure that to ensure a convergence of language and standards. So we clearly need to speak the same language and to be sure to bring trust and clarity to the market and to the investors community in particular. And that's where also exchanges have a role to play to really avoid fragmentation of the market, because it took a long time to manage to get trust and confidence in the market, at least beginning to get trust in the market. And this EU taxonomy that has just been defined, even if it's very limited in its scope because it's limited to climate change, mitigation and adaptation, economic activities, it's a very good beginning. And from what I understand as well, China is also working closely with Europe to try to make sure that their taxonomy converge. And it's apparently even called the Brussels effect, which is very good to know. And I hope that that it will be indeed spread worldwide, and that we will manage to at least have the same dictionary, because the taxonomy at the end is a classification of the different economic activities that are considered as climate aligned. And so we do not need exactly to make the same sentences, but we need to make sure that we understand each other, and that for investors it's very clear for them where their money is going, in what kind of projects they invest, and what kind of impact they will contribute to their through their investments.
Thank you so much, Julie. We have more questions, but I think we don't have enough time for but thank you so much. I think that we are in agreement, and very soon we are going to have another webinar around taxonomy. So I invite all our audience to participate in that webinar. And I think we are all in agreement from the audience and the panelists that training, knowledge, and capacity building is very important. And that's part of the objective of having this webinar series from the Green Banking Academy. So thank you so much. And I turn it back to Peter.
Thank you.
Thank you very much, Marcella. So let me take a shot at summarizing up the great comments and interventions from our panelists. And I'll refer back to the topic from the beginning. So how do we unlock capital markets post-COVID-19 to promote sustainable investment and climate investment? So Julie raised some great points about the importance of climate finance goes well beyond being a funding mechanism for an issuer. There's really a social and environmental benefit and imperative associated with sustainable finance. And to develop such a market, it's really important to have a dedicated market infrastructure that's designed to support climate investments, such as LGX. In 4 years, it's really quite impressive. They've supported 760 issues and 285 billion in issuance. So that just is a testament to the demand for the product and the importance of having dedicated infrastructure to support the sustainable finance. And then in terms of innovation, I thought it was a great point about not just moving the market beyond standard green bonds, but branching out into new types of climate bonds, such as sustainability-linked bonds, which can have a variety of indicators or social targets beyond even climate. We're also looking at forest bonds, blue bonds. So there's a whole cadre of potential new climate bonds that can be issued. Jean-Marie gave some great insights on the market itself, the overall bond market. So what really struck me is that 17% of the global bond market's facing a negative yield. So naturally, this is going to encourage a search for yield from these investors, and that yield resides in emerging markets. At the same time, issuers have an incentive to issue green bonds because, as he explained, the demand for green bonds is higher, hence the investment placement process can be easier. There's also great potential for growth in the green bond market. He gave the example of Sweden, where 21% of the bonds are green related versus 3% in the average for other markets. And I agree with him that I see great potential in renewables, for financing renewables as part of the green rebuild, and green buildings. Green buildings is actually probably the largest segment within the overall climate market. He also highlighted some of the challenges, such as the need for information dissemination, having issuers with proper incentives, and very importantly, the training aspect in capacity building on the part of issuers. And he has a training program, and we have the Global Green Banking Academy that is providing training in this regard. And he also commented on the standardization importance through ICMA, and it's so important to avoid against greenwashing. So for me, this session's been very insightful on how and why it's important to integrate emerging markets and their issuers into the global capital markets, and help bridge that gap between the financing need, which we explained is over 20 trillion, which is a huge number, and the ability of banks and others to fill, which they can't quite reach. I mean, I was encouraged to hear from Jean-Marie that we will actually hit the 1 trillion mark this year in the green bond outstanding. So that's we're definitely going in the right direction. So let me turn it back over. I think it goes to Carlos now for any additional concluding remarks. So thank you, everyone, from my side.
Well, thank you very much, Peter, and thank you very much, Julie and Jean-Marie, for a very, very interesting webinar and discussion on it. We have seen that there is a large pool of responsible investors with responsible money ready to invest in emerging markets and looking for impact without necessarily giving up yield. In fact, the reality has proof evidence that incorporating environmental, social, and governance factor in investment makes sense and pays from a financial point of view, and not only from a moral angle. Public money is insufficient to close the gap that I mentioned at the beginning, and we need to connect those large pools of responsible money around the world with the huge sustainable investment opportunities in emerging markets. Sustainable capital markets are in the growing path, and as we have seen today with the Luxembourg Stock Exchange leading this way. So thank you very much for participating. Thank you to our large audience. We have seen a lot of friends there and even presidents of banks, and we appreciate your participation and your time. And let me announce that next week, we are going to have a very interesting webinar. We have 2 more before we close for the summer break. And this is going to be greening the financial system. On August 6th, we will have a representative from the Central Bank of Mexico, Rafael del Villar. We will have a representative from the Central Bank of Spain, José Manuel Márquez. And we will have Mariana Escobar from the Colombian Superintendency that we are working, IFC is working with them in order to define the green taxonomy and some other initiatives. That is going to give us an angle from the central banks and from the supervisor's point of view of how we are going to integrate, how we are integrating a sustainable capital markets and how we are advancing the greening the banking sector agenda. So thank you very much for your participation. I wish you a very good week, and we look forward to seeing you next week. Thank you.
Thank you.
Thanks, everyone. Bye.
Thank you very much. Bye-bye.
Bye.
Bye.